Good evening, and welcome back to the making of Gurugram. In our first episode, we discussed how land ceiling laws, state acquisition, and sector planning created the legal and physical foundation of this city. Tonight, we step into a very different Gurugram. The decade between 2000 and 2010 was not just about growth, it was about speed. It was about private capital overtaking public planning. It was about land transforming into a financial instrument. This was the decade when Gurugram changed from a planned extension of Delhi into a privately developed metropolis. And in doing so, created both prosperity and fragility. Before we break this down into parts, R.K. Singhji, tell us plainly, why does this decade matters more than any other? Because Lalitji, this is the decade when intent and outcome diverged. Everyone believed they were building a world-class city. But the tools used, leverage, land banking, and speculative capital. Because Lalitji, this is the decade when planning stopped leading growth and capital started leading growth. Up to 2000, development followed policy. After 2000, policy started chasing development. Every structural issue we discussed today, stalled projects, regulatory tightening, buyer distrust, has roots in this period. R.K. Singhji, one question that keeps coming up again and again. What were the reasons behind the defaults, legal challenges, and eventual collapse or distress faced by real estate giant like Unitech during this decade of Gurgaon's growth? Lalitji, this is a very important question because these failures were not caused by one single mistake. They were the outcome of structural weaknesses that got exposed over time. Let me explain this. First, the core issue was over-leveraged land acquisition. During this phase, land prices in and around Gurgaon were rising rapidly. Developers believed that land appreciation itself would fund future construction. So they acquired large land banks using short and medium-term debt, assuming continuous sales and refinancing. When sales slowed, the debt remained. That imbalance triggered defaults. Second, there was diversion and misallocation of funds. Money collected from one project was often used to buy land or service debt for another project. There was no RERA. Once multiple projects slowed, cash flows collapsed across the portfolio. Weak corporate governance and promoter overreach were a critical reason behind developer distress. During this expansion phase, companies like Unitech and Parsvnath grew faster than their internal control systems. In the case of Ansal, there was also legacy exposure. Old land banks, delayed township projects, and mounting litigation related to delivery obligations accumulated over decades, not just in Gurgaon. For Unitech and Parsvnath, having multi-city presence, underestimated project timelines, land conversion and clearances, over-leveraging delayed their deliveries, creating interest cost up against the cash flows in contrast with DLF. DLF also expanded aggressively, but its governance architecture evolved alongside its scale. It maintained a clear separation between land ownership, development and monetization. Unlike its peers, it did not rely entirely on rolling pre-sales to survive. A significant portion of its portfolio was anchored in income-generating commercial assets, offices, IT parks and leased developments, which created predictable cash flows even when residential sales slowed. Second, DLF followed a measured land strategy. Instead of indiscriminate land hoarding, it focused on strategic parcels and phased development. This reduced pressure to continuously refinance debt and allowed flexibility during market downturns. DLF's relative resilience stemmed from stronger corporate governance and institutional discipline. Decision-making was structured, disclosures were clearer, and risks were evaluated at the portfolio level rather than project by project, which helped maintain lender confidence during stress periods. Finally, DLF demonstrated its ability to pause, deleverage, and recalibrate, reducing debt after the boom, monetizing non-core assets, and refocusing on premium residential and rental-led commercial models instead of pursuing volume-driven expansion at any cost. So to summarize, these companies did not fail because Gurgaon failed. They failed because their growth strategy assumed that markets would never pause, regulations would never tighten, and capital would always be available. Absolutely. So essentially, the city grew faster than the balance sheets could support. Exactly. Gurgaon survived despite the subprime crisis of 2008. Some developers didn't, because cities can absorb shocks, but leveraged business models cannot. So the contrast is important. Unitech, Ansal, and Parsvnath assumed that growth itself would solve risk, unlike DLF. This single difference explains why Gurgaon survived as a city and why DLF survived as a developer, while others faced defaults and legal challenges. Let's start with geography and politics. Gurgaon cannot be understood without Delhi. How exactly did Delhi shape Gurgaon's acceleration after 2000? Delhi by the late 1990s was constrained in three fundamental ways. First, land availability. Second, land cost. Third, regulatory rigidity. Delhi's development controls were tight. Large land parcels were almost impossible to assemble. Commercial expansion faced zoning and FAR limitations. Gurgaon offered the opposite environment. It had land at scale. It had a licensing framework rather than heavy acquisition. And it had proximity with Delhi and airport, a crucial advantage. Mr. Singh, how did the Delhi-Gurgaon relationship evolve post-2000? The Delhi-Gurgaon relationship was functional integration. Corporates moved offices because Gurgaon offered faster delivery, a compelling perspective. Professionals moved homes because Gurgaon offered space and aspiration. Developers followed where demand went. So Gurgaon became Delhi's release valve? Exactly. Every global city creates satellites when it hits internal limits. Gurgaon became that satellite, but with unprecedented autonomy. NH8 and the airport corridor turned Gurgaon into an international gateway. Later, Golf Course Road emerged as a premium spine. This geography alone would have created growth, but policy and capital amplified it. Many critics say Gurgaon grew without planning. But master plans existed. Where exactly did planning fall short? Planning did not fail in intent. It failed in tempo. Master planning operates on long horizons, 20-25 years. Markets operate quarter to quarter. After 2000, the master plans expanded sector limits, permitted group housing, and increased densities. But infrastructure provisioning, water, sewage, storm drainage, public transport could not scale at the same rate. Private developers responded rationally to demand. They built vertically, they maximized FAR, they launched faster. Public systems expanded slowly. The result was a mismatch. High-rise density without equivalent civic capacity, rapid occupation without mature governance systems. This imbalance did not collapse the city immediately, but it created stress that surfaced later. So Gurgaon looked world-class but functioned like a city still catching up? Yes, the skyline moved ahead of the system. This is also the decade when developers became more powerful than planners. That's correct. After 2000, private developers were no longer just constructing buildings, they were shaping urban form. Large players like DLF built integrated ecosystems, offices, residences, retail. Unitech expanded across segments and geographies, though shaken. Others followed with township and group housing models. The state licensed. The developer executed. A market-decided pace. This model delivered speed, but it also transferred systemic risk to private balance sheets. And land became central to that risk. Land became the anchor asset, not just for development, but for borrowing. Land banks were accumulated not always to build immediately. Land was no longer just soil. It was collateral. Let's talk finance, because this is where the boom turns fragile. Absolutely. Three financial pillars supported the boom. First, bank and NBFC credit. Second, investor pre-sales, the pre-launch culture. Third, internal leverage against rising land valuations. Pre-launch sales became common. Projects were often sold before construction began. Cash from one project was used to acquire land for the next. As long as prices rose and sales continued, the system worked. But the system required constant motion. It could not tolerate sales slowdown, credit tightening, regulatory interruption. This is the fundamental difference between a stable model and a leveraged one. So risk was invisible during the boom. Yes, because growth masked fragility. How important were IT and MNCs really? They were decisive. ITS firms needed large contiguous floor plates, quick execution, and flexible leasing. Gurgaon delivered faster than Bengaluru or Mumbai at that time. Commercial leasing created predictable cash flows. This had two effects. It attracted global capital and confidence. It encouraged developers to expand aggressively. Commercial success subsidized residential risk. Our commercial leasing cycles are also so global. When global demand slows, the shock travels fast. And then came 2008. The subprime crisis did not create Gurgaon's problems, it exposed them. Liquidity dried up globally, banks became cautious, corporate expansion slowed. Sales growth tapered, credit tightened, but debt obligations remained. Developers with rental income buffers, slower expansion, and disciplined leverage survived better. Those dependent on rolling pre-sales and land appreciation struggled. The crisis separated business models. So where did this decade fail structurally? In 5 ways. First, it treated land appreciation as cash flow. Second, it over-leveraged balance sheets. Third, it underestimated infrastructure needs. Fourth, it lacked consumer protection. Fifth, it had weak fund segregation, despite of the skyline rising faster than before. So regulation was inevitable. Yes, RERA, NCL, stricter lending norms. These were not anti-market moves. These were corrective responses. Markets expanded first, rules followed later. This decade built Gurugram's skyline and its risks. It delivered speed, aspiration, and global integration. But it also borrowed heavily from the future. In our next episode, we move into 2010 to 2020, the decade of slowdown, litigation, RERA, NCLT, and the Great Reset. Because cities do not collapse overnight, sometimes painfully.